By the time this red light turns green, the United States government will have added another $500,000 to its national credit card. By the time you scroll past 3 TikToks, it's added enough to buy a brand new car. By the time you finish your morning coffee, it's added enough to buy a house in Ohio. And the crazy part? Nobody in Washington is even pretending to slow it down anymore. That number just crossed $38.9 trillion. But it's not the total debt that should scare you. It's the rent we're paying on it. The interest payment alone, just the interest, not a single penny of the principal, is now larger than what we spend on the entire United States military. Every aircraft carrier, every soldier, every fighter jet, we are now paying more to bondholders than we pay to defend the country. The last time that happened on a sustained basis was 1934, the Great Depression, the year before Social Security even existed. This isn't just a story about a budget deficit. It's a story about the exact moment a superpower quietly stops being the kind of country it used to be. Today, we're going to walk through how this debt bomb just imploded, why it matters to your wallet, and what you can actually do to protect yourself. The fuse, how we got here. When you hear the phrase debt bomb, you probably picture a cinematic Lehman Brothers style Friday where everything collapses at once. But that's not what happened here. This bomb went off in slow motion over the last year, and we're standing in the smoke right now, arguing about whether we smell something burning. Let's look at the timeline. May 2025. Moody's, the last of the big 3 credit rating agencies willing to give the U.S. its top score, finally pulled the plug. We lost our pristine AAA rating, a rating we held since 1919. We kept that rating through the Great Depression, 2 world wars, stagflation, 2008, and a global pandemic. We lost it in peacetime because the math simply broke. Then the bond market started cracking. The Treasury held a routine auction to raise $25 billion. Think of it like a neighborhood yard sale, except of every 5 neighbors who said they'd show up, only 2.5 actually did. The buyers who did show up demanded a massive discount. Meanwhile, our biggest foreign lenders started packing their bags. China's holdings of U.S. Treasuries have fallen to their lowest level since 2008. What are they buying instead? Gold. Tons of it. Last year alone, they bought more gold than the entire reserves of Switzerland. They didn't just sell our debt. They bought a vault and filled it with physical metal. The math and Ferguson's law. Let me show you the math, because the math is far more disturbing than the headlines. We owe roughly $38.9 trillion. That works out to about $288,000 per American household. Your family's share of the national debt could literally buy you a house with a yard. Congratulations. And we're running a deficit of roughly $2 trillion a year, every year, forever. Let's make this real. Picture a married couple in Phoenix making $145,000 a year. They pay roughly $30,000 in federal income tax. Of that $30,000, about $6,000 goes straight to paying the interest on the national debt, not to roads, not to schools, just rent on money they never agreed to borrow. When politicians say they want to spend your tax dollars well, what they mean is they want to spend 80 cents of it well. The other 20 cents already belongs to bondholders. This brings us to a terrifying piece of historical context. It's called Ferguson's Law, named after historian Niall Ferguson. The law goes like this. Any great power that spends more on debt service than on its military risks ceasing to be a great power. He looked at 500 years of data. Habsburg Spain hit that point in the 1500s and defaulted 4 times. Bourbon France hit it right before the French Revolution. The Ottoman Empire hit it. Post-World War I Britain hit it and lost its empire over the next 40 years. Every single great power that has crossed this line has either lost its status or had to dismantle itself to survive. The United States officially crossed Ferguson's line recently, and the gap is only widening.
who do we owe? The trap. So, if we owe nearly $39 trillion, who exactly do we owe it to? More and more, we owe it to ourselves, and that should make you nervous, not relieved. Foreigners now own less than a third of our debt, and that number is falling. Japan and China are stepping back. Meanwhile, U.S. money market funds, banks, and pension funds are scooping up an ever larger share. We are financing ourselves, which sounds patriotic until you remember that financing yourself is exactly how countries like Argentina ended up in economic ruin. And here is the part the mainstream news isn't telling you. The government is now actively engineering new buyers. They've pushed legislation requiring stablecoins, the digital coins used for crypto trading, to be backed by short-term treasury bills. They are artificially creating trillions of dollars of captive demand for U.S. debt. It's like a restaurant losing its customers, so the town passes a law requiring everyone to order takeout. It's a bold strategy, but the financial pros aren't buying the illusion. Major money managers are projecting long-term interest rates to stay high. And gold, it's hitting record highs, crossing unprecedented milestones. When the smartest money in the world chooses a shiny rock that pays 0 interest over a U.S. Treasury bond paying 5%, that is the market quietly voting no confidence on the future of the U.S. dollar.
The four doors. So, how does this end? Historically, there are exactly 4 ways out of a sovereign debt spiral. Let's walk through the doors. Door number 1, austerity. We just cut spending. To stabilize the debt right now, we would need over $800 billion a year in permanent spending cuts or tax hikes. That happens to be roughly the entire defense budget. Show me the politician running on the platform of, "I would delete the Pentagon to balance the books." I'll wait. That door is locked. Door number 2, grow our way out. If the economy grows faster than the debt shrinks as a percentage of GDP. This worked after World War II, but today we are staring at the lowest sustained growth rates in modern American history. Even with the AI boom, we are going to need a lot more than ChatGPT to outrun a $39 trillion slowball. Door is mostly locked. Door number 3, default. We just refuse to pay. Technically possible, but if we do it, the dollar stops being the world's reserve currency, American savings are vaporized, and global trade stops. No serious person is suggesting this. Door locked by mutual self-preservation. Door number 4, financial repression. The door nobody talks about at dinner parties. You inflate the debt away. You print money, let prices rise, and pay off $38 trillion with dollars that buy significantly less stuff. You keep interest rates artificially below the rate of inflation, so the debt slowly evaporates over a couple of decades while everyone pretends everything is fine. Billionaire Ray Dalio recently called this a debt-induced heart attack. This is exactly how it ends. They print the money, they buy the debt no one else wants, and your dollars quietly lose their purchasing power until the math works again. What it means for you and how to prepare. Okay, let's bring this home. I know what you're thinking. Cool history lesson, but I have a mortgage, a 401k, and a kid who needs braces. What does this mean for my actual life? It means a lot, and it's already started. Look at housing. A $450,000 house today at a 6.5% interest rate costs you hundreds of dollars more a month than the exact same house did just a few years ago. Over 30 years, that's $1/3 in extra interest. The housing crisis isn't coming for your housing budget tomorrow. It already moved in. It's charging you rent right now. Then there's Social Security and Medicare. If you're 50 years old today, the Old Age Trust Fund is projected to run dry right as you hit full retirement age. That means an automatic cut to your benefits unless Congress acts. If you're under 35, your entire working life will be spent inside this era of financial repression, paying higher taxes, earning lower real returns and watching your purchasing power leak away. But here is where you take back control. Here is what serious investors are doing to prepare. Insurance against the dollar. Many top investors are keeping 10 to 15% of their portfolios in gold, not to get rich, but as an insurance policy against a declining currency. Real assets, real estate you can live in or rent out. Productive businesses. Invest in companies that have pricing power, businesses that can simply raise their prices when inflation hits. Short-term bonds. For the safe part of your portfolio, stick to short-term treasuries. Don't lock your money up in 30-year bonds at today's rates and pray. Use I-bonds and TIPS for actual inflation protection. And most importantly, do not panic. We are not Weimar Germany. We are the United States of America. This slow grind isn't the end of the world. It's just the end of a specific era. The era of cheap money, of free lunches, and of pretending that $39 trillion doesn't matter. The line on the chart is starting to break. The bomb already went off. You just got here a little late, which is fine, because most people haven't even shown up yet. You have time. Use it.